Are we standing at the edge of something much bigger than normal inflation? What if the surge we are seeing in gold and silver today is not just another cycle, but the early stage of a monetary breakdown? History shows that hyperinflation does not begin loudly. It begins quietly, with rising asset prices, energy shocks, political instability, and growing distrust in leadership. Then suddenly, confidence snaps. Welcome to Gold Silver Scope, where we break down gold and silver in simple, clear language so you can understand what is really happening beneath the headlines. Many analysts are now comparing today's environment with the early 1920s in Germany when the Reichsmark began its collapse. Back then, gold started accelerating sharply in the summer of 1922. At first, it did not look like hyperinflation. It looked like strong price appreciation. But what was really happening was a collapse in currency value. Gold was not going up on its own. The currency was losing purchasing power rapidly. Now look at our time. Gold breaking above 2,700 in 2024 was not just another resistance breakout. It was a structural shift. That move signaled something deeper. Today, gold is trading above 5,400, recently touching highs near 5,420. Even after pullbacks, it remains elevated. Silver is near the mid-90s range, with overnight highs approaching 96.50. These are not normal levels historically. These are signs of stress building in the system. Some expected even bigger explosive moves immediately, especially with geopolitical tensions rising sharply. But markets rarely move in straight lines. There are always forces attempting to smooth volatility. Official institutions often try to maintain order in futures markets to prevent panic. Whether one believes in direct intervention or not, it is clear that futures pricing sometimes behaves differently from physical market signals. What is interesting right now is the widening gap between Western futures exchanges and Asian physical markets. Reports indicate silver trading significantly higher in some physical markets abroad compared to COMEX pricing. That raises serious questions. When physical supply becomes harder to obtain and dealers temporarily suspend retail orders citing volatility, it suggests tightness beneath the surface. In the UK and US, some bullion dealers have paused online orders during fast market conditions. Yet prices are trending steadily upward, not crashing wildly. This creates confusion for retail investors. If markets are stable, why pause orders? Often when access becomes restricted, it signals stress building in the supply chain. Historically, these stresses eventually resolve through repricing higher. Hyperinflation, however, is not simply about high prices. It is about trust. Normal inflation happens when money supply expands and consumer prices gradually rise. Hyperinflation is different. It occurs when the public loses faith in the currency itself. Once confidence erodes, people rush to convert paper money into tangible assets. That shift becomes self-reinforcing. The classic case shows that hyperinflation accelerates when citizens no longer believe their government can manage finances responsibly. It is psychological before it is mathematical. Once the tipping point is reached, prices can spiral quickly. Today we see swelling deficits, expanding central bank balance sheets, and rising geopolitical instability. Energy markets are reacting sharply to conflict risks. Oil prices have jumped, with Brent crude moving into the high 70s to low 80s range, and West Texas Intermediate not far behind. Natural gas and industrial metals are also rising. When energy costs increase, transportation, food production, and manufacturing costs follow. This is how inflation can accelerate from multiple directions at once. It is not just monetary policy, it is geopolitics disrupting supply chains. It is fiscal stress meeting energy shock. It is rising debt colliding with declining confidence. Bond markets are also sending mixed signals. Yields are not collapsing dramatically, as one might expect during panic. Instead, longer-term yields remain elevated. That suggests investors are demanding compensation for fiscal risk, rather than rushing blindly into government debt. This is an important detail. In true safe haven moments, yields often drop sharply. When they do not, it suggests deeper structural concern. The stock market has shown weakness, with major indices pulling back. But equities can sometimes stage temporary recoveries if central banks respond with liquidity injections. If more money printing follows geopolitical stress, we could see stocks bounce again. However, if that happens, gold and silver could accelerate even more strongly. Hard assets typically outperform during aggressive monetary easing. Silver adds another layer to this story. Unlike gold, silver has strong industrial demand. When energy markets move and geopolitical tensions rise, industrial metals can become even more volatile. Silver often lags gold initially and then catches up with sharper percentage moves. That is why triple-digit silver is no longer unthinkable in this environment. Are we heading toward Weimar-style quadrillions per ounce? Probably not in that extreme form. Modern systems might collapse before reaching those visible numbers. But could we see gold in the tens of thousands over the coming years if confidence erodes significantly? It is not impossible. It depends on how quickly trust weakens. Hyperinflation is a collapse in confidence, and confidence, once lost, is very hard to rebuild. Now let us go deeper into the geopolitical and financial mechanics behind this potential shift toward a much more unstable monetary environment. Whenever there is military escalation in a major energy-producing region, the first market to react is oil. Energy is the foundation of the global economy. It fuels transportation, manufacturing, agriculture, and military logistics. When oil spikes sharply, it acts like a tax on the entire world. Brent crude moving toward the $80 range and West Texas Intermediate climbing strongly in a short period is not just a commodity story, it is an inflation signal. Energy price spikes rarely stay isolated. They filter quickly into shipping costs, airline tickets, food production, packaging, and consumer goods. Even natural gas and industrial metals tend to follow when supply chains feel threatened. Natural gas rising several percent in a short window is another sign that traders are pricing in geopolitical risk. Central banks now face a serious dilemma. If inflation accelerates because of energy shock, do they raise interest rates into a weakening economy? That risks recession and financial stress. Or do they ease policy to support markets and governments, knowing that easing could weaken currency confidence further? Both options carry risk. This is what we mean when we say policy credibility is being tested. Bond markets are sending a subtle but important message. Normally, during crisis fear, investors rush into government bonds, pushing yields sharply lower. But long-term yields have not collapsed dramatically. The 10-year yield holding near the 4% area and the 30-year staying elevated suggests investors are not fully confident in sovereign debt as a pure safe haven. They are asking for compensation for fiscal risk. This is where gold becomes extremely important. Gold does not depend on a government's promise to pay. It does not rely on tax revenue or central bank credibility. It is a neutral reserve asset. When sovereign risk rises quietly in the background, gold tends to gain strength even if headlines are focused elsewhere. Another key element is the psychological aspect of conflict. When wars drag on longer than expected, uncertainty multiplies. Markets hate uncertainty more than bad news itself. Even if initial strikes are described as limited or surgical, prolonged retaliation cycles can harden positions and destabilize entire regions. The longer instability continues, the greater the chance of energy supply disruption or financial contagion. Hyperinflation does not start because a government prints money for 1 year. It develops when repeated crises require repeated emergency responses. Each response may involve more debt issuance, more monetary expansion, and more fiscal strain. Over time, people begin to question sustainability. When the public begins converting savings aggressively into hard assets, that is when velocity increases. Velocity of money is critical in hyperinflation. It is not only about how much money exists, but how quickly people try to spend or convert it because they expect further devaluation. Historical accounts describe how citizens in hyperinflationary environments rush to buy durable goods, land, precious metals, or foreign currency. It becomes a race against time. Prices rise not only because of supply issues, but because of collapsing trust. Today, we are not yet in that final phase. Supermarket shelves are still stocked. Banks are still operating normally. Digital payments function smoothly. But the early ingredients are visible. Large deficits, rising debt-to-GDP ratios, geopolitical instability, and increasing political polarization. Stock markets may still attempt rebounds. Governments could use crisis as justification for liquidity injections. If that happens, equities might rally temporarily. But if that rally is fueled by monetary expansion rather than organic productivity growth, gold and silver could outperform in relative terms. Silver in particular is interesting because it sits at the intersection of monetary and industrial demand. In certain retail channels, physical silver products are already trading well above futures prices due to premiums and availability constraints. When physical and paper pricing diverge, it indicates friction in the system. If physical scarcity becomes more visible, futures markets eventually must adjust. Paper markets can suppress volatility temporarily, but sustained physical demand has historically forced repricing events. Another factor to consider is long-term sovereign debt cycles. Some macro analysts argue that we are nearing the later stages of a multi-decade debt supercycle. When debt grows faster than productive output for too long, restructuring or currency adjustment becomes inevitable. That adjustment can happen gradually through inflation or suddenly through crisis. Gold's breakout above previous long-term resistance levels signaled that global capital is beginning to hedge against such outcomes. Silver following closely suggests broader participation. Oil strength, stable but elevated bond yields, and rising precious metals together paint a picture of systemic tension rather than isolated volatility. Markets appear to be pricing a world where policy flexibility is shrinking. If confidence remains intact, the system can stabilize. But if repeated shocks erode trust faster than authorities can restore it, repricing can accelerate. Now let us bring everything together and speak clearly about what this could mean for gold, silver, and your financial positioning in the years ahead. First, we must stay balanced. Hyperinflation is a serious word. It should not be used lightly. It does not happen simply because inflation is high for a few months. It happens when trust in the currency system collapses. It is a psychological break as much as an economic one. Once people lose faith in the ability of governments and central banks to protect purchasing power, behavior changes rapidly. Right now, we are not in full hyperinflation, but we are seeing conditions that historically appear before major currency adjustments. Large and growing deficits, expanding central bank balance sheets, geopolitical instability, energy price shocks, and rising political division all weaken long-term confidence. Gold breaking above 2,700 in 2024 was a structural signal. Moving above 5,000 confirms that something deeper is shifting. These are not small moves. They represent capital flowing into hard assets for protection. Silver pushing toward triple digits in certain retail channels also shows rising stress in physical supply versus paper pricing. Could gold reach 20,000 or even 30,000 in the coming years? It is possible if currency confidence erodes significantly. That does not mean it will happen tomorrow. It does not mean it will happen in a straight line. There will be corrections. There will be pullbacks. There will be moments when people say the bull market is over. But structural trends tend to persist longer than most expect. Silver, because of its smaller market size and industrial demand component, could move even more aggressively in percentage terms. Historically, When gold enters strong monetary bull phases, silver eventually accelerates faster, but it is also more volatile. Investors must understand that volatility is part of the metal's personality. The stock market remains uncertain. It could fall sharply if geopolitical stress worsens, or it could rebound if central banks step in with more liquidity. If more liquidity is injected into an already fragile system, that may temporarily support equities, but it would likely push hard assets even higher over time. Bond markets are another important signal. If yields remain elevated during stress periods, it suggests investors are demanding higher compensation for holding government debt. That is not a sign of strong confidence. If trust erodes further, gold benefits. Energy is still a major variable. If oil continues rising due to prolonged conflict, inflation pressure will increase. Central banks would then face the impossible choice between tightening into weakness or easing into inflation. Both paths create instability. Gold performs well when policy options become limited. The key takeaway is this: hyperinflation is not just about numbers. It is about trust. Confidence erodes slowly, then suddenly. Markets can reprice very quickly when tipping points are reached. That does not mean panic. Panic is never a strategy. The intelligent approach is gradual diversification. Reducing excessive exposure to fiat currency, holding tangible assets, and thinking long-term are disciplined responses. Emotional reactions often lead to mistakes. History teaches us that during major monetary shifts, those who hold real assets preserve purchasing power better than those who hold only paper claims. Gold and silver have played that role for thousands of years. They are not speculation in times like these. They are insurance. If you have found this deep analysis helpful and you want clear, simple breakdowns of gold and silver without political noise or unnecessary hype, make sure you stay connected with Gold Silver PartScope. This channel is dedicated to helping you understand the macro picture so you can make calm and informed decisions in uncertain times.